Hi all, in this video we're going to talk about money. Um, Money is very important in the economy, principally because it allows specialization. Otherwise we'd have to all grow our own food and spend time doing that rather than specialize. Um, in economics, supply refers to the total amount of a specific good or service that producers are willing and able to provide to the market at a given price over a set period of time. Supply um, is clearly very important. Um, who knows why some economies in some regions are more energetic than others. It's a kind of given, the level of activity in a region and in an economy. And at the margins, we seek to understand at the margins how supply and demand change. We can see how aggregate demand is made up. Obviously, it's made up of consumption, investment, government expenditure, exports less imports. That we know. But it's not easy to manage this, and that's the principal role of government, maintaining the value of money and understanding demand and supply in the economy. Demand refers to the total quantity of a good or service that consumers are willing and able to purchase at various price levels during a given period of time. The key concept is the law of demand. The core principle states that, all else being equal, as the price of a good or services increase, the quantity demanded by consumers will decrease and consumers will rebalance their preferences. Aggregate demand is an economic concept representing the total demand for all finished goods and services in an economy. It's not a single directly reported monetary value like GDP or public debt, but it's pretty close to GDP. And one of the things we've sort of established as we've done these talks is that the general size of the economy is reckoned to be some 3 trillion. And in this talk, we'll see that the size of money, which we refer to as M4 or broad money, comes to a figure of about the same level of 3 trillion, and that public debt also magically comes to this figure of 3 trillion, so 100% of GDP. So economic assessments for 2026 are tending to highlight the sort of dynamics rather than absolute amounts. Growth trends, we know that growth in the UK is positive but sluggish. Consumption and investment, to my mind, it's surprising how resilient this has been given, geopolitical and economic and climate shocks, interest rates, cost of living pressure. This is constraining consumer spending and business capital investment. Now, government policy, fiscal policy, remains pretty constrained, with the government balancing fiscal discipline against the need to support household finances and strategic investment, such as upgrading the grid for net zero actions, and external factors. So GDP at 3 trillion is a pretty good metric. The aggregate demand curve, the AD curve, illustrates the relationship between the general price level in an economy and the total quantity of goods and services demanded, so real GDP, by all economic agents. And the core concepts are relationship. It shows the total amount of spending on domestic goods and services at various price levels. It's the sum of consumption, investment, government spending, and net exports, as we've said. And it has a downward slope. The curve slopes downward, meaning that when the general price level falls, well, doesn't often do that, the total quantity of output demanded increases. This occurs due to three primary reasons: the wealth effect, not quite so given such prominence by economists these days, but lower prices increase the real value of consumers' money, making them feel wealthier. But the deflation required for such a wealth effect is generally shunned as creating stagnation. The interest rate effect, lower price levels reflect the demand for money, which can lower interest rates and encourage business investment and household borrowing. Again, that can overheat, result in excess borrowing and inflation, which again leads to a cycle of rising interest rates. And the international trade effect, lower domestic prices make domestically produced goods more attractive to foreign buyers, increasing exports, and foreign goods relatively become more expensive, decreasing imports. It's important to differentiate between moving along the curve and the curve shifting entirely. I'll sort of pass over that element and go to aggregate supply. The aggregate supply curve illustrates the relationship between the total quantity of goods and services that firms in an economy are willing and able to produce and the general price level. So aggregate supply is divided into two distinct time horizons, as you might expect, short run and long run. The short run curve represents the relationship between the price level and the quantity of output produced in the short run. Typically when input prices like wages are sticky or slow to adjust. The shape is generally upward sloping. Why it slopes upwards? As the price level for final goods rises, while input costs remain fixed, firms see an opportunity for higher profit margins, incentivizing them to increase production. In the short run, capital is considered fixed, and firms respond to changes in demand by altering variable factors like labour. The long-run aggregate supply represents the economy's potential output when it's at full employment. In shape, it's vertical, it's the boundary. The level of output in the long run is determined by the economy's productive capacity, the factors of production, technology, labour, capital and resources, rather than the price level. Full employment, at this level, the economy is producing at its potential GDP. And there are various factors causing shifts in the aggregate supply curve. A rightward shift would be a technological advance, reduction in production costs, so lower raw material prices, improvements in productivity. And by and large, that's the kind of environment that we have, and that leads to growth. A leftward shift indicates contraction in productive capacity, and that can happen and has happened in recent memory. Supply shocks, increase in production costs, higher energy prices, and reduction in the labour force or capital stock. For example, as the labour force ages, more reliance is placed on migrant labour. So given that background in demand and supply in the economy, what is the role of the Bank of England? As we saw from our model of the economy, the Bank of England is required to constrain inflation, ideally to a long-term target of around 2%. And it does that through the public sector borrowing requirement, through its monetary policy. So we'll have a look at its core monetary tools now. But in general, the relationship between the Bank of England and commercial banks is of central importance in maintaining a price level and maintaining investor confidence to hold the financial assets. So the core monetary tools are the bank rate. The Monetary Policy Committee adjusts this rate to make borrowing more or less expensive, to slow money growth or make money cheaper, speeding money growth. Quantitative easing we've heard about, and that's a separate topic on its own. Quantitative tightening, similarly, the reverse of quantitative easing, when the bank reduces its stock of purchased assets and lets bonds mature without replacement, actively withdrawing central bank reserves from the financial system. And market operations, these are very important. The bank manages short-term commercial bank reserves by lending or borrowing funds to stabilize the banking system day to day. Again, you would think that we could measure money, and indeed we can. And there are measures of M1, M2, M3, M4. And the broader measure, which includes all types of money, whether notes and coins or deposits, that in aggregate is our sort of magic 3 trillion level. Public sector borrowing, the public sector borrowing requirement or the public sector net borrowing, or the public sector net cash requirement, that in each year the public sector borrows to maintain its expenditure. Our government expenditure is subject to the same diminishing rates of return as other kinds of expenditure. For example, if you hire more people and they spend more time, instead of lowering transaction costs in the economy, increasing transaction costs, and you at a micro level, you can think of the sort of zealous public servant, perhaps causing trouble rather than sort of easing the path of the economy. How that translates in the aggregate, obviously there are many different economies, and if you look at Eastern Europe and the traditional role of public expenditure on um, uh, I don't know, the KGB. It's not something that we have in the UK in the same way, which operates so outside the law and so outside um, the sort of defence establishment, and has its own tasks and its own way of doing things. And you can look at that government expenditure and say, well, is there a point at which this is now running into diminishing returns? And that's part of the role of government and governance, is to keep that control over government expenditure, which is, at some periods of time easier said than done. So monetary policy is the action that the Bank of England or government can take to influence how much money is in the economy and how much it costs to borrow. As the UK's central bank, the Bank of England uses those two main policy tools. The primary tool is the bank rate, and this is the interest rate paid on deposits placed with the bank overnight by eligible firms such as commercial banks. And when required, the Bank of England can buy bonds to bring down long-term interest rates on savings and loans through quantitative easing. So monetary policy affects how much prices are rising, called the rate of inflation, and the Bank of England sets monetary policy to achieve low and stable inflation. And that is the primary monetary policy objective. In practice, that means keeping inflation at 2% over the medium term, which is the target set by government. Subject to this primary objective, the Bank of England supports the government's other economics aim, which is strong, sustainable and balanced growth, albeit in recent years, for various reasons, growth has been more muted than in the past. So I hope that's a helpful discussion of money, aggregate demand and supply in the economy, and the role of the Bank of England. Bye till next time.